The recent 60% drop in Campus Footwear's value, causing it to dip below its IPO price, has pegged my interest. This prompted me to take a closer look at the footwear industry's potential for long-term investments. In today's video, we'll dive into 4 major players in the industry. We will analyze their brand strategies, financial performance, and growth prospects. And by the end of the video, I will reveal the 2 companies I'm particularly positive about for long-term investment. Let's take a closer look at brand strategies and market segments. Metro operates under various brand names including Metro, Moki, Walkway, Crocs, FitFlop, and Fila. Relaxo's brand portfolio includes Relaxo, Sparks, Flight, and Bahamas. Bata's brands encompasses Bata, Hush Puppies, Shoal, Marie Claire, Power, Bata Comfort, and others. Campus Footwear operates solely under its own brand name. The footwear industry is divided into 4 segments based on price points. The entry segment features products priced under Rs 1000. The semi-premium segment ranges between Rs 1000 and Rs 1500, and the premium segment spans from Rs 1500 to 3000, whereas the premium plus segment covers items above Rs 3000. Metro primarily operates in the premium segment with an average selling price of Rs 1450 per pair. Around 86% of its sales come from brands with an average selling price above Rs 1500. Relaxo focuses on the mass market with an average selling price of Rs 161 per pair. Bata India's presence extends to the entry and semi-premium categories with an average selling price of Rs 712. Campus, on the other hand, covers all price segments, with 28% of sales in the entry segment, 30% in the semi-premium, and 42% in the premium and premium plus segments. The average selling price for Campus Footwears is approximately Rs 631 per pair. Metro's store count has grown from 504 in 2019 to 730 in 2023, with a diverse geographical presence. Relaxo, on the contrary, maintains around 387 stores and has not experienced store growth in the past 5 years. However, Relaxo boasts a network of over 650 pan-India distributors and 65,000 plus retailers and multi-brand outlets. Bata holds the highest number of stores, expanding from 1,545 in 2019 to over 2,000 in 2023. Bata has also prioritized building a robust franchisee business, with over 419 stores as of 2023 and plans to further expand to 500 stores. This widespread network allows Bata to reach more than 1,370 towns. While Campus has fewer stores, it's rapidly expanding, growing from 83 in 2021 to over 200 in 2023. Campus also collaborates with over 20,000 plus retailers across 650 plus cities. Relaxo sold over 17.1 crore pairs in FY23, a decrease from the 19.1 crore pairs sold in 2021. Bata's volume sales have rebounded to pre-COVID levels, with approximately 4.85 crore pairs sold in 2023. Campus has experienced substantial growth, selling 2.35 crore pairs in 2023, representing a CAGR of 12% over the past 5 years. Metro operates with an asset-light business model, entirely outsourcing manufacturing. It collaborates with over 250 plus vendors, maintaining long-standing relationships with some for over 20 years. While 91% of Metro's revenue originates from in-store operations, it is expanding its online presence through e-commerce. Relaxo possesses strong in-house manufacturing capabilities with 8 facilities and a combined capacity of 10 lakh pairs per day as of FY23. It has a dedicated production line for fast-moving SKUs. Campus boasts a vertically integrated manufacturing ecosystem, producing 14% of uppers and 31% of shoe soles in-house, followed by 100% in-house assembly. Its manufacturing plants are situated in Haridwar and Ganur, with assembly operations in Dehradun. The annual capacity of these plants amounts to 34.8 million pairs. Campus has also significantly improved its online sales, with its share of revenue increasing from 7.8% in FY20 to 37.5% in FY23. Campus Activewear holds a notable 17% market share in the Indian branded sports and athleisure footwear industry, which is predominantly dominated by international brands. Relaxo commands a market share of nearly 20% in the organized, non-leather footwear category. Campus has exhibited robust sales and profit growth over the past 5 years, with sales increasing by more than 30% and profits exceeding 25%. The company also achieved a high ROE of over 20% year-on-year. On the other hand, Metro demonstrated a sales growth of over 15% CAGR over the last 5 years, coupled with a profit growth at a CAGR of over 20%. Metro consistently maintained an average ROE of 20% year-on-year over the same period. Meanwhile, Relaxo and Bata emerged as the underperformers in this comparison, with sales growth hovering around 5% CAGR. However, Relaxo suffered a significant blow to its profit, with negative 12% growth over the past 3 years. Bata's profit growth remained sluggish, with a CAGR of 8% year-on-year over the last 5 years. In terms of return on equity, Relaxo managed relatively better figures at around 15% year-on-year, while Bata underperformed its peers with an ROE of around 12% year-on-year. Metro enjoys the highest EBITDA margins among its peers, achieving a 32% margin in FY23 and consistently maintaining it above 25% over the past 5 years. Both Campus and Bata registered margins of around 24% in 2023. Among the mentioned companies, Metro, Bata and Campus observed an increase in margins from 2021 to 2023, while Relaxo's margins dipped from 21% in 2021 to 12% in 2023. Metro achieved PAT margins of over 15%, while Bata and Campus witnessed PAT margins at around 9%. In terms of ROCE, Metro, Bata and Campus recorded figures exceeding 20% in FY 2023. However, Campus has consistently maintained an ROCE above 20% for the past 5 years. Metro and Bata experienced a dip in ROCE in 2021, while Relaxo's ROCE decreased from 28% in 2021 to 12% in 2023. All three, Metro, Relaxo and Bata are debt-free, whereas Campus has a minimal debt-to-equity ratio of 0.3. The interest coverage ratio remains healthy, exceeding 7 for all companies. The Indian footwear market is on a trajectory to expand in volume, projected to reach 2.9 billion pairs by FY 2025. Simultaneously, the average selling price is anticipated to ascend, predicted to fall within the range of 490 to 515 by 2025. However, the per capita consumption remains modest at approximately 1.9 pairs, significantly lower than the global average of 3.2 pairs, and even more so compared to the 6.5 pairs typical of developed nations. In terms of value, the Indian footwear market is slated to exhibit a CAGR of 15 to 17% by 2025. The organized segment of the market is progressively gaining ground and is anticipated to witness a CAGR of 20 to 22% during the period spanning FY22 to FY25. By the fiscal year 2025, the Indian casual footwear market's estimated size is poised to reach approximately 662 billion INR. And the market size for the Indian sports and athleisure segment is pegged at around 220 billion INR. This SNS segment's addressable market is displaying notable growth, projected to grow at a CAGR of 25% from the 90 billion INR reported in FY 2021. India holds the distinction of being the second largest footwear producer globally, with the sector occupying a significant role in the Make in India initiative. This aligns with the direction of increasing domestic manufacturing, given the declining trend in footwear imports, the increasing disposable income, evolving lifestyles, emergence of the middle income group, and the growing millennial population collectively contribute to heightened demand for premium footwear offerings. Metro has set a goal to establish 200 new stores within the next 2 years. Building upon the success of partnerships and the expansion of brands like Crocs and FitFlop, Metro intends to leverage this platform to explore similar opportunities. The company will continue to prioritize the expansion of its online e-commerce presence to broaden its revenue streams. Additionally, Metro plans to foster growth in related sectors such as accessories, shoe care, and foot care. The company remains open to the possibility of inorganic growth, guided by factors like returns, scale, and diversification considerations. Relaxo aims to attain a return on equity within the range of 15 to 20% in the coming years. It also targets a double-digit volume growth in FY24 with a minimum increase of 15%. The company plans to uphold its margin at 15 to 16%. Relaxo possesses a strong capacity to meet demand for the next 2 years. The company will ensure its product remains relevant, competitive, and value-driven to fuel growth. Bata will drive the evolution of its portfolio with an emphasis on products such as sneakers, floats, and occasion and evening wear to sustain quarter-on-quarter growth. The company will continue to expedite its expansion through the addition of franchisee stores. Enhancing its digital footprint remains a primary focus for Bata. The company intends to optimize corporate overheads and concentrate on enhancing talent, processes, and technology. Campus has devised plans to achieve growth through both distribution and direct-to-customer channels, striving for a balanced 50-50 split. A new challenger brand will be launched in a small pilot during the coming quarter. The company's exclusive focus lies on premiumization, with a substantial number of designs set to be introduced in the INR 2000 plus price range. Furthermore, as a strategic move for future capacity expansion, Campus is acquiring a factory from Marico in Paontoa Sahib. From a long-term investment standpoint, I have a positive outlook on Metro and Campus. Metro's asset-light model and consistent emphasis on the premium and super premium segments have positioned it with the highest gross profit margin in the industry, exceeding 55%. With its robust store expansion strategy, growing e-commerce presence, and its role as a preferred partner for third-party brands, Metro indeed appears to be an attractive option for long-term investments. Campus, being the youngest company among the mentioned entities, boasts an aggressive store expansion plan along with a significant 50% revenue contribution from e-commerce. Its impressive return ratios, diverse product range spanning various price segments, and a recent correction in stock price further contribute to its appeal as a promising addition to a portfolio.